Hey guys, it's Richard, you're watching The Plain Bagel. I wanted to put out a quick video about the recent breaking news, the important headline in the space of finance and investments. The stock recently went up a lot in price. That's basically the video. Today we're talking about Tupperware. Yes, the company behind the iconic plastic container that's been wreaking havoc on kitchen cabinets since 1946, because as plain as a product might be, its stock has been anything but. With the stock going from trading under $1 and being at risk of delisting to rising over 700% over the span of just 2 weeks. And the reason for the skyrocketing price, management announced that the company might go out of business. Okay, that's not entirely true, but it's actually not all that far off. You see, Tupperware has become one of the latest examples of a meme stock, a term that I really hate using, but has sort of come to represent companies where the trading activity for the stock is irregular, doesn't really match anything else going on in the market, and isn't necessarily reflective of the fundamentals of the business, but is seemingly driven by retail demand and some sort of social media movement. And the funny thing is, this isn't the only stock experiencing this sort of rally at the moment. There's actually a delivery company, Yellow Corp, who recently ceased operations as it prepares for bankruptcy. Something I can only assume is because of the incorrect logo palette. But they too have seen their stock skyrocket after announcing that they were approaching a deal with Apollo Global Management to get new capital for turning around the business. And I generally try to avoid talking about specific publicly traded stocks because I don't want to communicate any sort of buy, sell, or hold recommendation here. And there is a chance that Tupperware stock does go up from here. My goal is not to try and predict where it will move in the short term. But whenever I see a meme stock rally of this sort, which we've had quite a few since the GameStop rally of 2021. Sounds like a national tragedy. But whenever I see one of these rallies online, I see a lot of cheerleading for these companies and a lot of inexperienced traders talking about how this is going to be the thing that causes the big foretold short squeeze. This will be the moment of reckoning for those darn short sellers in the market. And I wanted to cover the story, not just to kind of explain the situation for those who might be wondering why a plastic container company has shot up in price, but also to explain why this isn't us going back to the 2021 era of the GameStop rally, to explain why the company financially has not been performing so well, what's contributed to this recent stock rally, and any key takeaways for people who might be considering buying into this stock, or really any sort of meme stock that experiences this rally, and the things to be very, very careful about. So without further ado, let's hop into the exciting world of Tupperware. Now, Tupperware, as you might be aware, is a company that makes a range of kitchen products for storing, preparing, and serving food, but they're really well known for their plastic containers because they were one of the first companies to sell the modern polyethylene container that many of us use today. But despite becoming a household name, Tupperware unfortunately has not been doing so well lately. And I know most people describe investing as being like a roller coaster. I don't know that I found a stock that exemplifies that better than the Tupperware stock, because the stock went from nearly $100 in 2013 to $1.40 at the onset of the pandemic to nearly $40 in 2021 to back to under $1 before the most recent surge. But the stock having this big fall from grace, with sales falling since 2017, although there was an exception with 2021. The pandemic was ironically a glimmer of hope as demand for food storage containers went through the roof. But naturally, there's only so much demand growth when your core product is something that lasts for a very long time and has many imitators. And for 2022, the company reported a net sales decline of 18%, negative earnings per share, a total debt balance of $705.4 million, a particular problem given that the company's market cap is under $200 million, and the fact that we have skyrocketing interest rates and negative equity, meaning that they actually had more liabilities on their balance sheet than they did assets to cover them. On top of all this, management has actually postponed the most recent quarterly reports after finding some misrepresentations that also apply to some past filings of theirs. And despite management having a turnaround strategy, releasing new products like a freezable water bottle, and even going so far as to start selling their product in Target stores, which was a big deal for the company because, as you might be aware, previously Tupperware was actually a direct-to-consumer product that was famous for what they call Tupperware parties, where instead of having a storefront, they would actually have a representative go to a customer's house with all of their friends and basically sell to them directly. So while the company has since diversified to online sales from this weird American tradition, the Target announcement was still a big deal. But again, despite these efforts, management announced that there was a danger of them going out of business due to their massive debt load. And in June, the New York Stock Exchange warned that the company was going to be delisted from the exchange because of its penny stock status. or at least that seemingly was the case until a few weeks ago. Because from a starting point of 64 cents on July 19th, the stock rallied to $5.38 as of Tuesday close, a gain of over 700% over just a couple of weeks. So why did the stock rally? Well, much like the bottom of their popular product when it's been microwaved one too many times, it's not completely clear. Some attribute it to a recent debt waiver the company entered, with management announcing June 30th that they were able to negotiate a postponement on certain debt payments, which will give them more time to turn themselves around. But given that there were a couple weeks between that announcement and the recent stock rally, and the fact that this was actually the fourth amendment to that credit arrangement, it doesn't seem to stand out as a meaningful catalyst. Instead, a lot of people are attributing the rally to the company's ascension to meme stock status, with a lot of retail investors seemingly trying to carry out another short squeeze. A short squeeze, as a quick refresher, is when investors bid up a stock price high enough that short sellers are forced out of their position. The stock price rises so quickly that people who are betting against the stock lose so much money and are forced to cover their shorts, which means to buy back the stock, which inherently actually causes the stock price to rise further because now you have all these short sellers becoming buyers themselves. And with roughly a quarter of Tupperware's float being shorted, which is a relatively high level, many online saw this as an opportunity to achieve the alleged infinite money glitch that is the short squeeze. But this time, the rallying calls weren't really being done on Reddit, but rather stock twits, which, if you aren't familiar, is basically Twitter for stock traders, where the stock itself has a bullish sentiment indicator and a number of people are sharing posts encouraging others to buy and hold the position to help short squeeze the stock, with some also speculating that any moment now the stock might announce a turnaround plan. And last night it was announced that the company had reached a debt restructuring agreement with its creditors, which will buy it more time for its turnaround, something that's boosted the stock price today. Now, we don't have the latest short interest figures to tell whether the short interest has been impacted by the most recent rally, but we have seen the cost of shorting increase as a result of the stock price. With the cost to borrow fee, which is more or less the interest rate that short sellers have to pay a broker in order to borrow their stock for the intent of short selling, increasing from 6.52% on July 12th to 141% more recently. Now, it's worth noting that that's the annual rate, so it's not like the moment you short the stock, you actually have this kind of permanent write-down. But it is still expensive relative to the typical 3% or so you might see in the market. And as you would expect, this higher fee does discourage short selling on a given name, which, much like GameStop, may indeed have contributed to the recent rally we saw, as you have less of the sales pressure to offset this surge in buying pressure from these online communities. And it may be enough to convince you that this is a solid bet, that if you just get a bunch more people buying the stock, you're sure to win, that the short sellers will lose once and for all. And if you want to buy this company, all the power to you. Again, my goal is not to tell you what you should buy or sell, but before you decide to hop in, I do want to have a quick party pooper moment on meme stocks in general, so that you are better informed about what you're getting yourself into. For one, to anyone who's hoping that we're going back to the 2021 times where fundamentals don't matter and stocks only go up, we're not. We're in a very different macroeconomic environment, as we've highlighted in past videos. Obviously, interest rates are a big factor there. They've increased drastically since the pandemic, and yes, you can still have these short-term style stock rallies, but over the longer term, with rates so high, that is going to discourage a lot of speculation. It makes money more expensive for investors to put into the market and really discourages these type of asset bubbles. Compare that to the pandemic, where we had rock bottom interest rates, stimulus checks and other fiscal stimulus, and even quantitative easing, and we're just in a fundamentally different environment. Secondly, while there are very valid strategies around buying bankrupt or near bankrupt companies, it is a very difficult and high-risk strategy that requires quite a bit of expertise and attention to detail. Yes, if you were just to look at something like a relative valuation, the company appears dirt cheap based on multiples, but there's a reason for that. It's quite possible that investors get nothing, they go out of business and end up being liquidated, given again that they have liabilities that outweigh their assets. Yes, the announced restructuring is good news and does push the possibility of bankruptcy further down the road, but the company still has to turn around their operations. On top of that, the company's financials and reporting are pretty opaque. There isn't a lot of detail provided to let investors assess operations. So while some people may have a positive thesis around the company and its turnaround, it makes that already difficult task of making money from a turnaround even more challenging. Thirdly, if you're someone who's buying for the short squeeze, that elusive moment where the stock price reaches high enough that all the short sellers exit and push the price into the promised land, it's worth highlighting that even with the GameStop rally, we had an SEC report come out after the fact that showed that a short squeeze wasn't really behind the bulk of the stock price rally. There was some early short covering with the initial onset of the stock price rally, but during the most intensive part of the price surge, buy volume was primarily from long investors. So while the movement may initially begin as expected, it's likely that when you have these exacerbated rallies, they aren't really following that thesis of forcing short sellers to exit their positions. It's likely just speculative demand. And finally, it's worth highlighting that to date anyway, meme stocks don't have a great track record. GameStop, the company that really kicked it all off, while still up from its pre-rally levels, most of the buy volume for GameStop came after January 25th, meaning more than likely the majority of investors are actually down on their position, with volume weighted average price in the last week of January being more than double what the stock is trading for today. The same applies to AMC, with the stock being roughly in line with where it was pre-rally. It's likely that many investors that participated there have lost money. In Bed Bath & Beyond, the company that many believed was going to announce a groundbreaking deal to save the business and make investors a killing, has more or less gone out of business. They were relaunched online by Overstock.com, but they've lost their investors a ton of money. So while these type of stocks might have these short-term rallies, it's pretty clear that despite the diamond hands, a typical buy and hold strategy, which for the average investor tends to be the better approach, doesn't actually have that great of a track record. Most investors who buy in during the hype will lose money because long-term, earning a sustainable return requires the underlying business to actually turn around, which currently these meme stocks don't have a great track record around. And with it being so difficult to try and predict which stock is going to have the next meme style rally, I really wouldn't suggest the average person who doesn't have any sort of trading background try to play day trader in that space. For most people, unless you're investing passively, which is a very valid approach that a lot of people can utilize, you'll likely be better served focusing on companies with a more resilient business model that aren't on the verge of bankruptcy. Because unless you're doing that research and have that kind of background and expertise in the space of bankruptcies, you really are just gambling, especially if you're basing your investment decisions off of social media posts. I understand the allure of trying to jump into companies that see the skyrocketing return, but it's kind of the backwards approach to buy companies after they have already jumped the sizable amount. Unless you're considering things like momentum, generally speaking, chasing returns, not a good strategy. Anyway, that's a video. Thank you for joining me today. I promise I will be getting back to more in-depth videos in the future, but every now and then, whenever I see these rallies in the market, I do like to address it, hopefully to provide some grounded perspective on things, just so that you have more information. If you like this video, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. Let me know your thoughts on Tupperware, how you're doing, what you ate for breakfast. Anything helps the algorithm. And if you're interested, I will leave a link to the SEC report in the description below. I've referenced it a couple of times now, but really does a good job of demystifying what happened back with GameStop. Thanks again for joining me, and as always, be safe out there.